Hi, this is Stanley from Value Invest Asia. Very often we heard of the term price to earnings ratio or P ratio for short. And what does that really mean? To understand that, we have to understand first the concept of what we call stock valuation. Valuation is basically just a measure of understanding if a stock is cheap or expensive. For example, if we have two stocks, stock A is trading at just $1 per share and stock B is trading at $10 per share, which stock is actually cheaper? So this is actually a trick question because we do not have enough information right here to make that conclusion. Why is that the case? This is because price alone is not a standard unit of measurement across all stocks. So you can actually think of a company as just a piece of a pastry cake, and all different cake come in different sizes or quality and even design. So each cake might even be cut into different number of slices. So for example, cake A might be cut into 50 slices while cake B might just be cut into 4 slices. And if cake A is being priced at $1 per slice while cake B now is being priced at $10 per slice, can we really say that cake A is still cheaper than cake B? So you can see that if we're just comparing the price of a company, of a stock, we're not really comparing apple to apple. So to standardize a measurement of company, we would really like to measure them based on the same unit of measure. Maybe something like how much would a cake cost per gram. And so this is actually the art and science of valuation. And then the P ratio is one of the most common form of valuation measure. Price to earning ratio has a formula of the P ratio being the stock price divided by the earnings per share of a company. For example, the company might be trading at $10 per share, but can be making an earnings per share of about $1 per share a year. So if we calculate this P ratio just simply by taking $10 divided by $1 of earnings per share, that will give it a P ratio of 10. This means that for every dollar that the company earns, we are actually paying $10 if we want to invest in it. So you can see that generally we would prefer a lower PE ratio for a company. This means that we're actually paying lesser of per dollar of profit that the company is making. However, P ratio is just one of many ratios for an investor to look at for valuation, and it is definitely not a magic tool. It means that if we invest in a company with very low PE, it will not always necessarily mean that we are making a good investment decision. This is because there are some limitations to P ratio as a tool. Some of them include P ratio don't really tell us about the quality of the company. It also doesn't tell us if the company is actually growing its earnings or shrinking its profit. And it certainly doesn't help us if the company has very lumpy earnings, which makes the P ratio fluctuate very wildly year after year. And lastly, of course, it certainly does not help us if the company is not making any profit at all. So we can see as P ratio is a type of valuation measure, and in general, the lower the PE, the better it is and the cheaper it is for us as an investor. But PE ratio is just one of many tools that an investor can use to understand a stock. So use it wisely. Till we meet again, invest safely.